Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones and Associates Premier Financial Solutions. Listeners, lots of great information you're going to hear on our show today, but if you'd like more information, you can always visit our website at jonesfinancialtalk.com. Lots of great information on that radio page. You can check out all of our past shows. You can subscribe to our great program on Apple Podcasts, Spotify, and Google Podcasts, and even Amazon Music. And please reach out to us and ask about future topics for the shows. That's how we came up with this one today. Lots of clients I sit down with call me and ask about specific types of annuities. And one of the most, common concerns that I hear is, we bought this annuity or we want to consider annuities for some steady and reliable income stream during our retirement. And that sounds like a great idea, obviously, but there are so many different intricacies with annuities that I think we should definitely spend a great amount of time explaining what those are, why you'd be interested in them, because for many people, other things that they have, pensions, Social Security, aren't going to provide the sufficient income that they need. And so annuities are a great tool if they're used correctly and understood. So we're going to discuss kind of the potential options for building that retirement income with annuities today. And as you can see, Mr. Tony Shore is going to join us again to help me explore that topic. How are you, Tony?
Oh, I'm doing great today, Nick. Thanks for asking. I've had a great week so far. And, of course, this is a great topic. It's interesting because there are so many misconceptions out there when it comes to annuities. So I'm glad we're going to tackle this. But first, yes, I have been great. Very busy, though. I've got too much going on. It's crazy. I thought once we got our youngest off to college, things would slow down, but no, it hasn't. How about you? How have you been? You guys this is kind of headed into your really busy season, isn't it?
It is, yes, the third and fourth quarter, because we do a lot of tax planning that needs to take place before the end of the year with conversions of things like Roth IRAs, as well as tax planning and tax harvesting, things of that nature definitely take place in the third and fourth quarter. So we are very, very, very busy. Everybody is back to work, meaning most people take vacations during the summer. So these are the busy months for us for sure, Tony.
Yeah, I would imagine they are. Well, I know that this is quite a topic, and I think that it's going to be a good one because I have family and friends all the time. Nick hit me up with questions about annuities, like, are they really good? Are they really bad? I hear they're really bad. So I'm looking forward to some answers on today's show.
Yeah, and Tony, to begin, so many people tell me that they know and they've heard of what annuities are, but very, very few can actually fully explain all of the details.
Sure.
And that's largely because, there are just so many different types of annuities out there. Also, I'll just make an interesting point here. In the past, most annuities are insurance products that are often sold rather than, purchased. And so what does that really mean? Well, that means that many consumers are kind of nudged into buying an annuity, and sometimes they don't completely understand or even need those annuities. And so this is probably one of those specific products that you need to spend a lot of time with your financial advisor reviewing to understand if they're going to be a good fit for you before you jump into any decision. And so there's lots of things that you can do prior to purchasing an annuity, like becoming knowledgeable about the different types. But also when you own an annuity, there might be different benefits and features that you're not even fully aware of that you definitely should have a discussion at least annually about with a financial advisor.
Wow. Okay. So since a lot of folks might not know exactly what an annuity is or what it does, give us a definition.
Okay. So just at the root, an annuity is basically a contract between you and an insurance company that's going to address some concern that you have. It might be principal protection. It could be lifetime income, could be your legacy, or it could be the potential future costs of things like long-term care. And so, annuities are not traditional investments, okay? Even though they're typically advertised that way and can sometimes make it seem like they are. They're contracts that seek to transfer some type of risk, like I mentioned. And so with an annuity, you and an insurance company are bound by some type of contractual obligation, and breaking those obligations, if it's even possible after you get into the contract, may come with some significant financial penalties.
Yikes. I don't like penalties. I just want you to know that.
Yep. Yep.
So, okay. I know annuities have been available to consumers for many years now, but what about the history of annuities? How long have they been around?
They have been around for centuries. Actually, they can be traced as far back as ancient Rome when people would make a single payment in exchange for regular lifetime payments. It goes that far back, Tony.
Wow. Okay. That's interesting. So, even I guess ancient Roman retirees wanted enough income to maintain their lifestyle then.
Sure thing. And, in the United States, annuities gained great popularity during the Great Depression when people were worried about, the stock market volatility and how that was going to affect their retirement. And, today, with pensions less common, and very, very high inflation, as we've highlighted many times on our show, some people are turning to annuities to potentially supplement their Social Security income. And, so I don't want you to be fooled, though. While the high level, explanation of annuities can make them seem very, very simple, they're definitely not. And so the rules surrounding annuities can be very complex. Again, you've got to sit down with somebody and talk to them about your specific situation to see if it's something that even makes sense.
Yeah. Well, and that brings me to my next question. Is purchasing an annuity a good idea?
So obviously, just like many other financial tools, it comes down to everyone's current situation and the future needs and goals that they have.
Sure.
Personally, I think one of an annuity's biggest potential positives is that they often supplied some type of guaranteed income for the rest of your life, no matter how long that is. And furthermore, annuities may provide additional tax sheltered opportunities to save for retirement
Yep.
if you've already reached the limit of your 401k or IRA. Because annuities don't have contribution limits, you can save as much as you're able to inside these types of products, and have those be tax sheltered for some time.
Wow. Okay. So that's great. I like that. So give us a little more information about how annuities work then.
Okay. Okay. So, as with other insurance products, you pay annuity companies a premium in exchange for them bearing some type of risk, like we've discussed. Often you pay that in a lump sum, or sometimes you can pay it through installments. Unlike other types of insurance, you don't pay premiums forever because eventually your payments stop and the annuity starts paying you, right, in some way, like an income. And so in some cases, annuity payments may also be very, very flexible. You can structure them to provide payments for a set number of years to you or your heirs, or until you or your spouse die, possibly with a lifetime income benefits that we'll talk about later. There's also period certain annuities that provide lifetime income, but if you die prematurely, the contract actually will pay out your beneficiaries for a stated amount of time. And those payments can be made monthly, quarterly, annually, or in a lump sum. And so they are, there's lots of little differences here that we should discuss, and we will continue to.
Yeah, sounds good. Let's take a moment, though, to let our listeners out there know how to get a hold of you. And I'll remind our listeners, all you have to do is go to jonesfinancialtalk.com, and it's spelled just like it sounds, jonesfinancialtalk.com. There are a lot of great resources there. You can listen to this show, past shows. You can subscribe to the show as a podcast. There's also a contact form there, or a link to the main Jones & Associates page, where there's really a plethora of great information for our listeners out there. Now, let's keep rolling. I think you've done a great job of giving us some annuity basics. What's up next?
Yeah, so annuities are created to create some type of benefit directly for you while you're still alive, and so the clearest benefits are probably the potential for some type of guaranteed retirement income stream.
Yep.
But before we go further, let's talk about that. A lot of people think bad things when they hear the word annuity, but Social Security and pensions are kind of an annuity if you think about it, Tony. Right?
That's true. That's
Lots
true.
of times when you have a pension from a company at the end of your career, they'll offer some type of lifetime payout that they're going to give to you forever. And this happens in the state of Oregon with the PERS system, for instance, where you've got 15 different options to choose some type of payout depending on the work history and service that you have there.
Yeah.
It could be single payout. It could be a payout for you and your spouse. It could be a lump sum, right? And Social Security on the flip side is much more straightforward, but it is an annuity. And the longer you wait,
you pay in money. You pay in money. You pay in money ahead of time, and then you get a guaranteed monthly payment.
That's right.
In retirement. And
annuity, and depending on how long you wait, right, you get more. So the age of 62 or 67 or 70.
And that's exactly how an annuity works from what you're telling us.
That's right. And when you think about annuities from income perspectives, which we'll talk a lot about, I think, in the second portion of the show, a lot of this has to do with longevity, right? So an actuary is going to determine how long or how old typically men at a certain age or women at a certain age are going to live. They don't ask you to fill out any specific questionnaire about your health. They don't know anything about you. And they can't legally do that, but they can estimate, and that's what they do.
And that's interesting. I think it's earlier in the show, I know you talked about different kinds of annuities, right? So go into a little more detail about that.
Okay, so first and foremost, there are two common types of annuities out there. Okay, so there's deferred annuities and there's immediate annuities. And as their name suggests, deferred annuities provide an income stream later, while immediate annuities offer income almost right away. And there's many different types of annuities that we can discuss, and we can go into some details about those now also, Tony.
All right. That sounds good. Obviously, there are a few different kinds. I know some of them are really popular right now with retirees. Used to be there were, I've heard of variable annuities, and I think that's where they kind of got the bad name. But I hear about things like fixed index annuities. So there are completely different types and styles of annuities that do different things and have different structures, aren't there?
There are. So we can start with some of those. So we talked about immediate annuities, right? So immediate annuities are annuitized, which means that they're converted to an income stream right away. And the way that these work is it's just based on today's current interest rates. You've got a lump sum of money. You have a certain amount of time that an actuary thinks you're going to live. They're going to guarantee some type of growth inside that immediate annuity. And based on that, they're going to tell you how much you can draw starting right now from an annuity income standpoint for the rest of your life. So that's the most kind of basic term, an immediate annuity. And then you've probably also heard, Tony, of deferred annuities, which on the flip side is set up to grow for some certain amount of time. And the reason why we want that to happen is so that the income that you will pull out of that annuity later is going to be much greater than if you just started it today.
Okay. And within those two categories, immediate and deferred, are the types I was mentioning, right? Like a fixed a fixed index annuity, which we hear a lot about.
Yep. So let's just kind of start with the most basic type of annuities and kind of work our way up. Probably the simplest, I would say, type of an annuity is some type of a fixed annuity, and that supplies some type of a guaranteed minimum rate of return. And it can also supply you with a fixed series of payments depending on how that works. But today, we've talked a lot about what are called multi-year guaranteed annuities, or MYGAs for short. And so a MYGA is basically a CD that's issued by a life insurance company. Okay, so today, I don't want to quote any specific rates, but basically, you can get a 3 to 5 year multi-year guaranteed annuity that pays somewhere in the 5 to 6% range. And that's like a fixed CD. Okay, now I want to make sure I point out that the annuities are not FDIC insured, right? So CDs are FDIC insured by the bank that they're issued. And we saw some issues with the FDIC insurance earlier in March when a couple of banks went under. There's actually, I read today, quite a bit of restructuring going on at the FDIC right now.
I would hope so, yeah.
Right? They're trying to organize and make sure that they have enough things set up and aside for other banks if we have more options and issues. But I should bring this up. So annuity companies guarantee the annuities based on their backing power. And because they don't have to give you all your money back at one time, they've got lots of resources to have billions of dollars on the books to generate income to then pay out all the people that are asking for
Sure.
that monthly income. And with annuity companies, we often look at their ratings, right? So you want to have an A-rated high-end company, and you also want to look at what's called their solvency ratio, Tony. That is how solvent the company is and how much money they have on the books.
Yeah, yeah, and you want the company to be very solvent, and so that's great. And I know that to have that type of guaranteed income is so important. You need something besides Social Security, which is a guaranteed monthly income. That's why most people don't have pensions. You can basically set up your own personal pension with an annuity, right?
That's exactly right.
Yeah.
And the insurance company that you select is bearing the risk, right, of the market fluctuations rather than you.
Sure.
I should mention one other thing. It depends on the state that you live in, but many states, like here in the state of Oregon, the Department of Insurance has insurance companies pay into a fund. And so there is actually insurance at the state level for failed annuity and life products in certain situations.
And I
So
believe that it's up to a cap. The cap for that your money is insured through the state for insurance companies is almost exact. I think it's the exact same level as the FDIC. I think it's $250,000 of your money in a bank. Up to that is insured by the FDIC, and most states cover insurance companies up to $250,000 of your money. So
that's right. So
yeah.
in the state of Oregon, it's actually 300,000. It's
Oh
just a
wow,
little bit
okay.
more.
Yeah, that's good.
But the
That's
important
nice.
thing about that is depending on the state you live in, you have to have this conversation with your advisor because maybe you should diversify, depending on how much money you have, your money into multiple annuities, right? Just like you would with multiple banks. And so a lot of people say, well, I've got $1 million in one bank. And I say, well, make sure that you've got enough FDIC insurance in each of those accounts to help qualify you if, God forbid, something terrible happens. And that's the same point that you want to make with insurance companies.
Sure.
I mean, insurance companies are actually more solvent than most banks. And
Yes.
maybe I'll just touch on that. I mean, Tony, the big five, the biggest banks in the country today, like Chase, for instance, and others, have solvency ratios around 50, 60, 70%. And what that means is if 100% of their clients came to them and said they want all their money back, they could basically make 50, 60, or 70% of them completely whole. They don't have all the money. The reason why they don't have all the money is because they've loaned it out
Sure.
to make money on,
Right.
right? But an insurance company cannot loan your money out. And so A-rated, top-rated insurance companies have solvency ratios over 100%.
Yeah.
Because they have
I think
to keep all the profits on the books.
they're required to have 110%.
That's right. So most are right around 105 to 120% because they have to keep all their profits on the books. And that's
But again,
a very,
you want to
important
work
point.
with A-rated, B-rated companies, top-rated. Yeah, in the top ratings.
And so if you're getting back to kind of the commercial of annuities, if you are seeing offers for annuities locally in the newspaper or on TV or wherever, and you're hearing I'm getting a 7, 8, 9, 10% guaranteed rate of return, you need to question before you buy that, like, what's the rating of the insurance company that I'm looking at here? How is the structure of that built? What are those guarantees actually that they're providing me? Because Tony,
and what are the fees?
And what are the fees, which we'll talk about. But here's the thing. There are insurance companies that go broke, and there are some that go under. And so if you're in that situation, even if it's guaranteed by the state, you might not have access to your money or income until they actually go through the process of recouping as many assets as they can. So it's not one of those things that's just a simple set it and forget it. And so it's a very, very important conversation to start with your advisor.
Yeah. And so what about there are let's talk a minute about variable annuities. I think this is where annuities get their bad name, right?
You are exactly correct. And let me start by saying that variable annuities are an investment product. Most other annuities are insurance products.
Right.
Okay. Huge designation and difference there. And so you have to have certain licenses to be able to sell variable annuities, which we have at Jones. And so that's one thing. And the reason for that is because there's investments that are tied to the markets that are built into these types of annuities. And as the word variable obviously stands out, variable, the risk in those portfolios can go up and down.
So there is risk versus
you're taking downside risk in variable annuities. And so
versus a fixed index annuity where there really isn't any downside risk, your principal's protected.
That's right. And that's the same thing in those fixed annuities, the multi-year guaranteed annuities, for instance. Last year, everybody remembers how bad the market was. The market overall, general broad indexes were down, say, 20%.
Yeah.
Well, a lot of people that had purchased variable annuities 3 years, 5 years, 10 years before that had great returns in the variable annuities. Why? Because the market went up.
Yeah.
But last year they went down, and those are the types of people that have knocked on our door this year and said, wait a minute, I was told that this annuity had some type of guarantee, and I see that I just lost 10, 15, 20% of my account value in just 1 year. And I said, yes. And that's why people have negative, connotations about annuities, mostly because of the variable annuity situation. Now, I don't want to beat up on variable annuities completely. There are some good variable annuities that you can utilize in your structure as well, Tony. But there are many variable annuities that provide very, very meager returns, and the reason for that is exactly what you mentioned, which is fees.
Okay, well, let's talk about fees for a minute on all different types of annuities. Let's start with variable annuities. So I've heard that's a reason annuities are bad, because of high fees, and that, it's not, you don't get to keep your principal because there are fees. With variable annuities, there are high fees, right?
There sure are. So let's highlight some of those fees. And part of the reason why there's a fee in a variable annuity is because there's some other specific type of product that inside or investment inside it. Okay,
like an IRA or a 401k or a stock investment.
The stock investment. So the investment.
You pay for fees in those.
That's right. So when you buy an investment, you're going to pay somebody a fee to manage the investments inside that portfolio.
Yep.
And in variable annuities, they typically use what are called mutual funds to invest and get the performance return like the markets. But those mutual fund companies and managers have to get compensated. And those fees can range from anything from 0.5% to 2%, depending on the portfolio that you choose inside the investments for that specific variable annuity. And then on top of that, there's also mortality and risk expenses. So what are those? Death benefit expenses that they are building into the policy for your heirs, and then also administrative fees. And Tony, in many situations when I sit down with clients, they come in and they say, Nick, depending on what you're going to help me invest my money in, you're going to charge me a fee, and you need to explain that. And of course I do, because I'm a fiduciary. It's in black and white writing. They can see it. But I said, you're paying a fee today in what you own also. And they said, no, I don't think I am. And part of the reason why they say they don't think they are is because they don't directly see it on their statement.
Right.
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 And so
their 401k, there's a fee, like the money they put into their 401k, a portion goes to a fee to manage those portfolios.
Yep. And so a very easy way to explain that is, let's just say that you got 10% return in your 401k or your investment or your variable annuity last year. You really made something like 11 or 11 and a half.
Yep.
And the insurance company retained their expenses before they gave you your performance.
Yeah.
In the basic term.
And I've heard of variable annuities with fees as high as 4%, 5%, 6%.
Yeah. So if you tack on an investment fee and then a mortality and expense ratio fee and also an administrative fee, many times expense ratios of variable annuities are in the 2.5% to 3.5% range. And here's the problem, listeners. If you're taking that money and you're investing it in the market and you're expecting to get an 8% return, well, what do you really have to get in order to get 8%? You've got to get 11, 12, 13% return in order to net 8 after the expenses.
Yeah, that's tough.
And that's really tough. And then on top of that, imagine paying those fees 2, 3, 4% when the market goes down 15 or 20, like it did last year.
So you not only is the market down 10, but you're down 13 because of your in that account because it's a variable annuity and you're paying 3% fee on top of the loss. So I get that. Variable annuities, I know that you're not a huge fan, but in some cases, for some people, they are a good tool. It depends on the contract and the variable annuity. But people shouldn't shy away from all annuities because of fees, because some have little, if any, fees, right? Like the fixed indexed annuities are so popular right now, Nick, with all the baby boomers who have been retiring. I mean, I know a lot of people who heading into retirement got fixed index annuities, and they like them because the principal's protected, and they say they're paying no fees. Now, is that true?
That is true, and I want to highlight that. But before I do, really quickly, I want to mention there are definitely good variable annuities as well. But many people think if you're just using a variable annuity for the investment portion of it, you can probably do better outside of the annuity. If you want some type of guarantee built into your investment account and want to take more risk in the market, maybe a variable annuity is a good fit. And so we have used those for some clients, but not all. But Now we're going to talk about fixed index like you asked.
Sure.
So fixed indexed annuities, let's just talk about the word. Fixed cannot lose value. The only way that they go down is if you take money out of them. Okay. Indexed, they are tied. That's how they grow. They are tied to some specific index. The most well-known indexes are the S&P 500, the Dow Jones, the NASDAQ, but they can be also invested in indexes that are in commodities, are in real estate, are in precious metals, right? So fixed indexed. Index is how they grow. And then annuity, payment for life, if you decide that you want to do that, is an option. Okay, once again, can't lose value in a fixed indexed annuity. Typically, you don't pay any fees inside a fixed indexed annuity if what you're trying to accomplish is just growth. If you're looking for income and you want guaranteed income, you may pay a fee. And we'll talk about that in a second. But the way that the fixed indexed annuity works is the insurance company is bearing the risk. You give them $100,000, and they're going to tell you today what the rate of return is that you're going to get if the market goes up. Okay. In some situations, they'll guarantee a specific fixed rate of return as well. So today, in short-term fixed index annuities, they'll say for the first year, if you just want to get fixed interest, we'll give you 5%. But if you want to take risk in the market trying to get more return, we'll let you do that, and you can make up to 10 or 11% if the market goes up. Okay. Why are you capped on the 10 or 11%? Because they protect you from all downside risk. If the market turns against you out of your favor, they bear the risk, you don't.
So like last year, if I have a fixed index annuity and the market dropped 17 to 20%, my balance can't go below zero.
That's right. The only way that your balance goes down is if you take money out of it. Okay.
Yeah.
So that's for like a growth oriented fixed indexed annuity.
But there is a fee for a lifetime guaranteed income for a
You're
lifetime.
Right. So there are many other benefits that you can put into the fixed annuities that do charge fees. One of those, and the most popular, is called an income rider. And what those do is they provide income for life based on the amount of money you have in there and your age. You can have a single payout, meaning just for yourself, or you can have a joint if you're married for a spouse. And so that's what's called a second to die policy.
Yeah.
So let me just throw a hypothetical example out there for people to understand. Let's say that you are 70 years old, you have $100,000, and you put $100,000 into a fixed indexed annuity, and you buy an income rider. They might tell you, okay, based on your age, you're going to get $7,000 a year guaranteed for the rest of your life. But if you do a joint annuity because you and your wife both want the guaranteed income, you're only going to get $6,500. You're going to get less. Why? Because they're insuring that income stream for both of your lives. So it's a second to die policy. So if one of you passes, the other spouse still continues to receive that income payment. Okay.
Okay. But like the fees for that lifetime or an income rider to get a guaranteed lifetime income, for the standard one, it's pretty low, isn't it? The fees are pretty
Point
low for a fixed index annuity.
Many are under 1%. Some
Oh,
are
wow.
right at 1% or above.
Sure.
One thing I always like to mention to clients too is if you're looking at some type of solution like that, that's where a lot of the guarantees are built into annuities that people don't understand. They say, oh, I was told that I get 6% guaranteed or 7% guaranteed. That could be true on the income side, but it wouldn't be true on the cash side necessarily. They're not going to say, if you have $100,000, we're going to give you $7,000 free every single year, right? That you get to take out. That's not necessarily the case. So, and one other very, very important point, a lot of times I review fixed index annuities for clients that have purchased that income rider, like we're talking about, Tony,
Yep.
and they assume that it will go to their heirs. And that's definitely not the case, because if your children are your beneficiaries and they're 20 or 30 years younger than you, the annuity company is not going to pay them that $7,000 in the example I used for all of their life.
No.
I mean, they can't do that. Your child might live another 50 or 60 years, right?
Yeah. Yep.
So it's really, you just have to look into all the different benefits and how this kind of works.
Yeah. Well, I think before we go, people need to sit down and go over different options. They should not get into an annuity without working with somebody like yourself. And if they already have some type of product or investment like this, they can have you review it to see if it's right for them. How can they get a hold of you and set that up?
And that's a very important thing, because one thing I did not have a chance to mention on the show today is because interest rates are so much higher, fixed indexed annuities and fixed annuity opportunities are through the roof. And that's why the whole industry has boomed this year, because the offers that they're providing to clients are just so much better than they were last year and the year before, because rates are so much higher.
Yep.
But Tony, they can just reach out to us at jonesfinancialtalk.com. We get this all the time. If you have an annuity or you're interested in anything like that or any other product, please just request that information on our website, and I'd be happy to talk with you one-on-one about your specific situation.
All right. Sounds good. And listeners, that does it for today's episode of Jones Financial Talk with our host, Nick Jones.